to take more control of his risk management, to obtain underwriting profits that previously went to the insurance company, and basically to better manage his risk.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Weekly, we share interviews with real estate experts passing on their experience and knowledge to our listeners. Thanks for joining us this week. My name's J. Darren Gross. We're so glad you're here. In just a minute, we're going to speak with Hale Stewart, an attorney specializing in captive insurance company setup and operation. Before we do, though, I want to invite you to subscribe to our program if you like what we're doing. You can do that on either iTunes or Stitcher, whichever you prefer. We're on both. It's super easy. Just go to the search bar on either one and type in Commercial Real Estate Pro Network. And when you see our logo, it's the headphones with CREPN between the ears. Go ahead and click subscribe. This will ensure that you receive all of our episodes, and you can listen anytime you choose, whether it's in the car, at the gym, or even at your kid's sports practice. When you do subscribe, be sure to leave a comment and let us know what you think. For those of you who don't know me, I'm a real estate investor and a commercial property insurance broker. I've been an insurance broker for over 25 years, and my primary clients are real estate professionals dealing in multifamily, retail, warehouse, office, and development. Also, I'm a real estate investor and have been for almost 20 years. And based on this, I'm always looking for more information about real estate so I can better support my clients and for information I can use in my own investing. And that's how Commercial Real Estate Pro Network and CREPN Radio came about. Insurance is a part of any real estate transaction, and when you or your clients make an offer, and if you need some help with your insurance, please give me a call. I'll do all I can to help. That's what I do. The easiest way to reach me is you can either do that at jdarrengross.com or commercialrealestatepronetwork.com. Just go ahead and know the contact information there and drop me a line. If you're on LinkedIn, I want to also encourage you to check out our group, Commercial Real Estate Pro Network. It's a great group of commercial real estate professionals, good place to network. All right, a little bit about today's show. Insurance is a part of real estate. It's one that most buyers would rather not participate in, but it's necessary, and it can be a lifesaver for your business, your income, and your future. If you have a large portfolio of real estate and you had a good experience against claims, I mean, you've had few or no claims, you've probably wondered, is there another way to protect my property and somehow benefit? Well, we're about to find out. On the line with me now, I've got Hale Stewart. Hale Stewart is with the law offices of Hale Stewart. He's also the co-author of U.S. Captive Insurance Law. Hale, welcome to the program.
Thank you for having me, Darren. I'm very glad to be here.
Well, I'm excited to get in this today because what we're going to talk about today for our listeners is captive insurance. And insurance is not usually one of those topics that people get excited to talk about, but I think this is going to open some eyes as to the possibilities of how insurance might be a benefit, or there might be some different ways to think about insurance. And but before we do that, Hale, if you could do me and the audience a little bit of a favor and give us a little bit of background on you and your experience and your practice.
Sure. I'm an attorney specializing in transactional work. I have a master's in both domestic and international taxation, so that's really kind of the heart of my practice. I helped clients form and manage legally captive insurance companies, which are insurance companies that are owned by the insured. I've been doing this for the last 7 to 8 years, and have helped a lot of clients solve a lot of insurance problems thanks to this particular structure.
All right. Well, let's talk a little bit about that. And before we do, I just kind of want to seed this with some experience I've had on the sales end of insurance. I'm an insurance broker and have been for 25 years, and I think the average person that buys their home and auto insurance always feels like it's it's a grudge purchase, to say the least. Nobody's excited about buying their new insurance policy.
Sure.
But as your risk gets bigger, and the risk of loss, and now we're talking about protecting your assets. And if you've got in this case, we'll try and keep the focus on real estate. But if you've got real estate assets that are in the hundreds of millions of dollars, and you're paying hundreds of thousands of dollars in insurance, but yet your claims experience is little or none, you can even grow that grudge, if you will, or that grudge can grow to thinking like, man, I'm really wasting my money here paying the insurance company. Now, obviously, once they have a loss and they have a claim and it gets settled, they're grateful they have the insurance. But the whole premise of insurance is not everybody's having a loss every day, and that's why the thing works. Otherwise, it wouldn't work. And so what caught my attention, and the reason why I reached out to you about talking today, was just that situation where there are those that spend a great deal of money on insurance. They have relatively clean loss history, and is there a way we can, or they might be able to restructure their risk transfer to where there may be some benefit for them as opposed to just an expense they pay the insurance company every year. So with that, if we could start off and talk a little bit about what is a captive reinsurance a program, and
Sure.
go from there.
A captive insurance company is an insurance company owned by the insured. So just hypothetically, suppose that for the last 10 years, you've purchased your commercial property policies from Acme Insurance Company. If you form a captive, either A, your captive will provide all of your insurance needs, so you will no longer purchase your insurance from Acme Insurance Company, or you'll still purchase some of your insurance from Acme, but you'll use the captive to, for example, increase deductibles of your property policies so that you take more risk take the risk on yourself. And you'll also use the captive to fill gaps in insurance. For example, in the property world, we know that the average property policy has known exclusions: mold remediation, asbestos abatement. Most property policies for properties along the coast have very large windstorm deductibles, and we can underwrite those in a captive. Typically, what winds up happening is the insured forms what I call an insurance tapestry, and that is that he uses a combination of third-party insurance and captive policies to take more control of his risk management, to obtain underwriting costs, underwriting profits that previously went to the insurance company, and basically to better manage his risk.
Gotcha. And you mentioned, I think, just in kind of the structure, it doesn't have to be an abandon the traditional insurance purchase, but more of would this be a frontline kind of thing? Because I'm assuming the traditional program, you said you go with a higher deductible,
Sure.
And then put your captive in as a frontline. Am I hearing you right?
Yeah, and that's standard. Like, for example, the insured purchases a standard property policy, again, from Acme Insurance Company. In forming the captive, he now has a $250,000 deductible with his property policy from Acme. And the captive underwrites what's called a deductible reimbursement policy. And all that means is that in the event the insured has a claim below $250,000, then his captive pays the entire claim.
Gotcha. Does the policy for the captive, does it reflect the policy that's the traditional policy, or can it be broader in scope?
Actually, this really highlights another benefit of captives, which is the ability to draft the policy. So, for example, in the example I just used, the captive underwriting $250,000 deductible with the captive. In that situation, the policy that the captive underwrites would in a number of ways have to mirror that of the third-party policy. And that's because the two policies have to work together. In other cases, we have a very broad policy. Like, for example, it's very standard for captives to underwrite what's called a legal liability policy. That policy provides coverage for your lawyer in the event you're sued. We can draft that so basically once you either go to arbitration, mediation, or court, or even threaten with that, then you can trigger the policy and have the insurance company begin to pay your legal claim, the legal expenses related to those particular claims.
Gotcha. So the basic, and just trying to again walk through this so myself and the listeners, because I think that one of the challenges is that I found is it's a sexy topic to walk right up to, but it seems kind of messy and a little more involved than the average buyer cares to get, but it's kind of rolling up your sleeves and understanding exactly what this is, that really where the rubber meets the road and how it can benefit you. So if let's just for example's sake, let's stay with the real estate investor that's got I don't know, is $500,000 a year in average premium, is that a threshold where somebody could take advantage of this, or should it be more than that as far as?
Well, it's best to think of it in terms of the parent company and to look at it from a couple of different perspectives. Number one, let's say the parent company has a minimum of, say, $3 to $5 million in gross revenue. At that point, the company's has probably met the minimum revenue threshold. Another way to look at it is the type of risk that the parent company has, because that could lower our threshold. Now, with commercial real estate, you clearly have a business model that has more risk. For example, just the natural disaster component of owning commercial real estate. If you own property along the coastline, you've got hurricane issues. If you own property on the West Coast and even actually moving into the mountain inlands, you've got earthquake issues. If you have property in the Midwest, you've got tornado issues. So because the commercial real estate is a riskier venture, we can lower that top-line gross revenue amount to, say, $2 or $3 million. Finally, we can also look at the parent company's insurance expense. If they're spending probably about $200,000 to $250,000 of income per year on premiums for their insurance policies, that's about the minimum that you need for the captive to really be viable.
Got it, because I think that's one of the things that it always, like I said, it's a grudge purchase to begin with, but there's a tipping point where taking on the risk as opposed to transferring the risk, it might not make sense. So in this, let's focus on the one that's spending north of $250,000, because I think that's probably a realistic threshold there. But so on the setup, I guess I want to kind of go back to this on the coverage form. We talked about the traditional policy in place. You said that you can either mirror that traditional policy, but let's take just like the Gulf Coast area. I mean, the wind is a huge thing that insurance companies are scared to death of. Mm-hmm. The way that they've written policies to account for this is they put a percentage deductible. Yep. The percentage deductible is a percent of the limit, not percent of the loss. So, and they usually have a minimum deductible. So it's not uncommon for a buyer to automatically, when they buy their policy, be accepting a $20,000 deductible or more based on percentage. I mean, there's usually like a minimum dollar amount, but then there's a percentage beyond that. And, it can be quite expensive to where you basically bought a whole new roof or whatever for all of your buildings based on the event itself. Sure. And I think you mentioned there you can set it up as a deductible reimbursement. Mm-hmm. Are there? I guess what I'm trying to understand here is, just that underlying policy. When I write the captive, one of the reasons to do it, do people do it more for broader coverage, or just a way to kind of like a savings account for that deductible, or is there some thinking?
Each insured is unique. I tell you what, to answer that question, let me walk you through the average captive formation process, okay?
All right.
And we'll use the favorite Acme commercial property company as an example. They decided
a reputable company.
A reputable company.
There you go.
They have, let's just say, 10 commercial properties located in Texas, which is my home state. The first thing that we'll do is request all their current policies and their loss history. We do that, obviously, first of all, to review their current policies to see the coverage they have, the exclusions they have, the limits they have, et cetera. And we're also going to look at their claims history to begin to price premiums. Once we look at these policies, we'll note a couple of things. We'll say Acme Commercial Real Estate Company has a standard Texas property policy. They have the following exclusions in their policy. And for example, in Texas, a mold exclusion is common now. They own property in Galveston, Texas, so they have a windstorm deductible. And that windstorm deductible is, say, a minimum of $25,000 or 5% of the market value of the property. They also have asbestos abatement. They also have a pollution exclusion. These are the things that we're going to note with their policies. Then we're going to look at their claims history. What has been their claims history? Have they filed a lot of claims? Have they filed no claims? Are they just a middling amount? Whatever. All this information I will look at legally, and I'll also pass it on to an actuary who's independent, who will determine what the potential policies might be and what the premiums for those policies might be. Typically, we'll wind up with a menu of, say, 7 to 15 policies. And in the commercial world, there are traditional policies. Like, for example, again, if you go to the average third-party insurer, they'll sell you property, commercial general liability. They've also got some fairly large specialty lines, employment claims, employee liability, these types of things. So just as we have standard policies in the commercial world, so too do we have standard policies in the captive world. And a lot of the captives, the policies that we underwrite in the captive world, are policy lines that the third-party insurers stopped writing a long time ago or never wrote. And again, that's why I was talking about mold remediation or asbestos claims. These are exclusions that third-party insurers are not going to write. So that's what we underwrite in the captive world. So the lawyer, and the actuary will look at their policies and their claims history, and after, between 2 and 4 weeks of analysis, depending upon schedules and time of year, et cetera, we'll come back to the insurer and say, okay, here are your third-party policies, and here are some policies that we can underwrite in the captive that will broaden your coverage, that will fill in gaps in your current policies, and basically allow you to take a lot more control of your risk. Once the insured has that, he says, great, let's go ahead and form the captive, and starting in year 1, I will purchase the following 7 policies from my captive. At that point, not only is Acme Property Company a commercial real estate entity, but they're also the president of Acme Captive, and they're in the insurance business.
Well, So now they're collecting premium, which, I would think that there's that's kind of the yin and the yang of it. Yay, we get to, we're paying ourselves, or at least we're not giving it to the insurance company, but now all of a sudden we're on the hook for these claims, but that's kind of all that actuarial that's been set up there. So, but I think though the aha that I think would appeal to potential buyers or captive program people is that ability to be more in control of the outcome there, and that knowing and betting on themselves based on their own experience, recognizing that they've had a positive experience, that the insurance companies have done pretty well, based on collecting their premium year after year, that now they're going to be able to collect that. And
I'll give you two quick examples in that area. We formed a captive for medical practice up in the Northeast, and they had a property policy. After the hurricanes that hit in 2013, 2014, I forget the name, but they'd filed a claim with the property policy, and they had a loss of income rider. They said, we lost approximately $200,000 related to I think it was Hurricane. Anyway,
is it Sandy or
Sandy? Superstorm Sandy. That was it. Their insurer came back and said, we'd love to pay you $200,000, but because of this neat little provision in the policy, we're only going to pay you $25,000. And the way the policy was written was that if you couldn't determine whether the loss was related to a utility failure or Sandy, then the maximum amount of payout was $25,000. And what the insurer was banking on, and correctly so in this case, was that the insurer just was not going to go to court over this, because this was a gray area of the policy, and they probably could have fought it. But only after 2 or 3 years of very expensive, time-consuming, and very annoying litigation would they be able to do that. So as a result of that very bad experience with their property underwriter, we formed a captive for them. Another example is a company that formed a captive here in 2008 after Hurricane Ike. And Hurricane Ike hit. They had a tremendous amount of damage to their roof, but the insurance company dragged their feet related to the claim. It took them about 1.5 years to finally get reimbursed for the funds they expended. So they formed a captive. They wrote a large deductible for that captive, basically to gain control of the claims process so they wouldn't have to go through that experience again. These are very typical situations, is that you have insurers who actually had insurance, and then they filed a claim, and because of the size of the claim, the insurance company started to fight back. And they started to say, we're not going to pay you what you think you should be paid, but we're going to carve it down by 25, down to 25% of your proposed settlement, because we just don't want to pay that much. By owning their own captive, they now have control of the claims process, so they don't have that problem anymore, especially with commercial real estate, where you've got large repairs and time is of the essence. Like, for example, you have an apartment building. The roof is hit hard by hail as a result of a storm, and you've got to bring in the roofing guys literally the day after the storm hits, and you need money for that. Well, the insurer is going to, because a lot of other people are filing claims, the insurer is going to say, we're going to be slow on this one. But if you own your captive, at that point, document the claim, bring in the roofing guys, and boom, money's out the door, and you're ready to go again.
What you're saying, I'm following along here. I just had some thoughts here. I wanted to kind of back up here to make sure we fill in the at least the gaps in my mind, or the points. So one of the things I think people get lost in sometimes with insurance is they don't realize that insurance is basically, a contract and money. There's no construction crew on staff with an insurance company that, adjusters don't come out with their hammers and fix your building. They have a spreadsheet, a calculator, and checkbook is that's what they're equipped with. What are, so we've got this captive, we've got this claim, is the owner of the property going to go out and adjust their claim? Is there can you tell us a little bit about how the captive, who are the players in that captive? I mean, you've got the property owner is I guess the capital element, but there's still, I mean, somebody has to adjust the claims. Do we have an in-house adjuster? Do we go third party? Can you talk a little bit about that?
Sure. The insured is also on the board of directors, and they're also the executives of the captive. So the insured is in control of that. Let's use the example that I just previously used. A building is hit by some type of damage related to windstorm, and they have a captive to underwrite it. In that situation, we would ask that they go through a routine bidding process. That is, they bring out 3 roofing companies, again, it'll assume it's a roofing damage, to bid on the project. And at that point, they have to evaluate the bids and say, we like company B best because of this. Here are the criteria that we use to come to that decision. And so long as the criteria conform to what's called the business judgment rule, which is a common law concept that basically says that executives have to use prudent sense to come to their decisions. So long as we can document that, that's really what we need from the captive side. If the company wants to go so far as to hire a formal claims adjuster, et cetera, they're more than welcome to, but it's not required. What is important is that we can document that they exercised reasonable care and the required amount of due diligence to make sure that the claim was properly taken care of.
Gotcha. And you cut out a couple layers of noise as far as settling a claim. So you have a storm, it blows your roof off. Immediately you get your 3 contractors out there, you get your bids. You select number 2. Do we turn it into our claims department for payment, or how does that?
Exactly. And again,
or can we go ahead and pay it and then submit it after we've paid it, or I guess
it can go either way. Ideally, what would happen is the parent company would pay for the roofing, and the captive would reimburse it. But depending upon cash flow, et cetera, it's just as possible for the captive to pay the claim directly. Either way is fine.
Right.
But again, what we need to document is that we have a captive that's being run like a standard routine insurance company. But as you mentioned, we can also cut out layers of red tape and bureaucratic slowdown.
Well, and I wish I knew somebody that would like that, but that might be a hard sell there, Hale, to find somebody that doesn't like the dance.
Understood.
Yeah. Let's run this here a couple different ways. So let's say that year 1, Acme Real Estate forms the Acme Insurance Captive. And, oh my God, year 1, all the roofs blow off. We've got, we've got the oh my God that we thought would never happen and happened. Year 1, we just put the money in the thing. I mean, I assume, could you wipe out the captive in year 1? Is that possible, or is that all actuarially kind of thought through?
Okay, that is always a statistical possibility. It's what I call the asteroid crashing into the Earth scenario. Yeah, it possibly could happen, but it's highly improbable.
No, I get it. Yeah.
In addition, the captive will be well capitalized. For example, let's suppose that we are underwriting a deductible reimbursement policy for Acme Corporation. In that situation, the captive may only be responsible for, say, $250,000. The captive will have more than enough capital to pay for that. And worst case scenario, let's assume that year one, the asteroid literally does hit the Earth, and the captive, the claims are too much for the captive. At that point, the captive pays out what it can, and then it closes.
Right. Well,
So,
and again, that's
scenario.
kind of the extreme there. I mean, obviously, I would think anybody going into this is while that's a remote possibility, based on your experience, you're betting that that's not going to be the case. So,
and that's also central to the actuarial science, is that actuaries they're very, very capable and very bright folks. And they assume that, okay, there is a probability that we could have the horrible scenario hit. Let's be prepared for it.
Right. Okay, let's go the opposite direction. Let's say that our good experience that we've had that got us to consider doing a captive continues. Mm-hmm. And year one, nothing. Year two, maybe a small little claim, but over a period of 3, 4, 5 years, we've got a pile of reserves, is what the insurance companies would call that. Describe, I mean, what becomes of that, or does it become a self-funded thing to where eventually you could essentially not have that premium, or is there describe the scenario where somebody has a good experience for a number of years.
Sure.
What are we looking at there?
Okay. I tell clients that over an extended period of time, and by extended I want to say 10 to 15 years, okay, they should expect to pay 3 to 5 claims. And by the way, I will back up here and explain just a bit of difference between captives and traditional insurers. Captives underwrite what an actuary would call stochastic risk, low frequency, higher payout. Whereas the standard insurance company, they want predictability to their claims. So that's the primary difference.
What was the word you used?
Stochastic.
Stochastic.
Yeah. With the captive, over a 10 to 15 year period, you will wind up paying out, again, 3 to 5 claims, higher in nature, say, let's say $40,000 to $60,000 per claim. As that capital builds up, the captive has to invest it prudently. Under federal law, we have to walk and talk like an insurance company. So that means that our investment portfolio should look like an insurance company's investment portfolio. I almost always recommend 40% bonds, 60% S&P 500 stocks for that. But again, that money builds up over time. Now, is it possible that we could come to the point where we have sufficient reserves built up to where we can start lowering the premium payment going into captive? Yes and no. With commercial real estate, because the probability of the big scenario is so high, we will probably always wind up paying at least some premium in the captive, largely out of concern that Superstorm Sandy is right around the corner. But yeah, the captive eventually builds up funds and becomes its a standalone insurance company. So
maybe instead of not paying, or I guess I said maybe possibly reducing your payment, would it also be a strategy to take on more risk and reduce the second layer, or I mean the
exactly.
Traditional? Okay.
And again, going back to the Acme commercial real estate company we were using, and the hypothetical that we discussed, we originally had a combination of third-party insurance and captive. It's possible that over an extended period of time that Acme could say, you know what, we no longer need a traditional property policy. We have sufficient capital and reserves to pay for that ourselves.
No, that's clearly a possibility. It's funny too. I think most people may not. I mean, maybe they've heard the terms, but they may not be fully aware of how insurance companies actually insure against the risk themselves. They buy reinsurance.
Sure.
So even if you're dealing with ABC Insurance Company, they're going out and buying insurance on the risk that they've agreed to insure.
Sure.
For you, and they take on that first layer of risk up to a cap, and buy insurance on the balance there. So essentially, you are, like you said, you're setting yourself up like an insurance company, acting like an insurance company, and behaving as an insurance company would. So let's carry this out here a few years. We've created the Acme captive insurance company. We've had a good go of it. The point in the future, nobody sees when they're trying to grow their business, but eventually there comes a point when either a sale or transfer or liquidation, whatever. What is the insurance company? I mean, do you disperse it? Do you sell it? What's the end on that?
There are two potential end games. Let's suppose that John Smith, who was the owner of Acme Corporation, started off by owning one building, and at the age of 65, he now has 15 buildings, and he wants to sell Acme Corporation to a bigger commercial real estate company. And he also has Acme Captive, which has now been funded for 15 to 20 years. He has two options. He can either A, include Acme Captive as part of the sale, and make that part of the price, or B, perhaps the person purchasing Acme Corporation has his own captive and doesn't need a captive. Either way, it really doesn't matter, because to Joe Smith, the owner of Acme, the sale leads to capital gains treatment. So if he liquidates it or if he sells it as part of the end game, it's taxed at a capital gains tax rate.
Gotcha. Makes sense long term.
Yep.
Capital gains. You just while you were talking there, it occurred to me, if a company set up the Acme captive insurance company was so well or performed at such a high level, what would prevent it from branching out beyond its own Acme properties? Would there be? I mean, obviously you don't want to get too crazy, because you could wipe out all the good that you set up. But I mean, if you're acting like an insurance company, would there be anything that prevents you down the road from operating it as an insurance company and making it available to others?
You can do that. At that point, though, you run into problems with state law, which is that how do you acquire the new customers? If you're soliciting their business, then you're no longer a captive insurance company, but you're a full-blown insurance company, and you'll have to submit to state regulation. So, as simply put, most companies don't do that.
Gotcha.
Basically, they keep the captive in-house and just leave it there.
Makes sense. I just, one thing led to another there, as I was thinking there.
Understood.
Yeah. Well, this is very interesting. Like I said, the conversation of the grudge purchase that is just a constant. People buying insurance, but to recognize that there are ways for possibly to participate in that and essentially create an asset as opposed to just a line item expense. I would think would be of appeal, or would appeal to those that are spending great sums on their annual insurance billing.
Sure.
And having
short version, for any company that meets the criteria that we outlined earlier, a captive is a wonderful addition to its corporate family. What first attracted me to captives was the fact that a company that was not in the financial intermediary business could own a financial intermediary, and the economic and financial benefits of that are tremendous. Basically, there are no downsides to this. There are only upsides. It's a wonderful opportunity.
Right. Well, looking down my my kind of outline and some questions, I feel like we've kind of touched on the who, what it is, how it works, and who would be an appropriate candidate. Is there something that we didn't talk about that would be helpful to the conversation for what we've touched on today?
We covered everything. I think we did. I think we went over the whole transaction fairly well. But the only thing that I would add is that if you are interested in this for your business, Darren and I will be putting a webinar on together on August 4th. It'll be occurring at 12 p.m. Central Time. And when you sign up for that, we'll also be sending you a white paper that will explain captives and the captive insurance transaction as it relates to commercial insurance companies. And Darren will put a link up on his website, and so will I, for this particular webinar.
Right, and I'll put that in the show notes there, so anybody that sees this can click and participate. I'm looking forward to it. I think this is it's a fascinating, actually not just fascinating, but a realistic opportunity for people that and investors that have sizable insurance bills and predictable good or have had good experiences with losses and stuff to take another look at another way to take control of some of their expenditures. So.
I agree completely.
All right. Well, Hale, I can't say thanks enough, and looking forward to joining you on the webinar there in August. And again, I'll post that all in the show notes. And I want to point out, too, also for people that don't know, you and I connected on LinkedIn, and I would encourage anybody that's on LinkedIn to check out your profile because you've got a wealth of information there as well on some of your slide shares and et cetera.
Yes, I do.
All right. Well, Hale, I appreciate your time, and we will be in touch. And again, look forward to participating on the webinar.
That'd be great. I appreciate it very much for your time. Thank you very much.
Well, there you have it. A possible way to participate and take control of your insurance program by forming a captive insurance company. I hope you found that interesting. I can't tell you how many times I've had the conversation with clients, but the conversation basically stopped because there was nowhere for it to go. So if you're more interested in learning about how a captive works, or if it's right for you, I encourage you to sign up for the webinar that Hale and I will be doing on August 4th. At noon Central. You can see there's a link in the show notes on how to sign up and save your seat for that. Before we get out of here, again, I just want to remind you to subscribe if you haven't yet. That way you'll know exactly when any new episodes are posted. We know you're busy, and we thank you so much for making time for us today. We do appreciate you. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.